Spalding from Ceres. And Ceres, for those of you who don't know us, we manage an investor network of institutional investors, about 135 now, asset owners and asset managers, with about 17 trillion in assets, who work together on sustainability issues and climate in particular. So I'll talk a little bit about what we've learned from our network members, where we're seeing some trends, and how particularly our investors are moving on the clean energy and low carbon investment. And then I'll have some questions for Alicia and Michelle, and I'll let them introduce themselves. Why don't you introduce yourselves first?
Sure. Hi. It's a pleasure to be here. I have to say, I will get to this later, but I do convene meetings like this from time to time at Stanford, and this is just exceptionally well done in terms of the engagement and the progression. And so thank you for having me. So I'm Alicia Seiger. I'm the Deputy Director of the Stanford Steyer-Taylor Center for Energy Policy and Finance. It's a mouthful. It's a joint initiative with the Business School and the Law School at Stanford, and our mission is to develop and explore economically sensible policy and financial mechanisms to scale up financing for deep decarbonization globally. I also have the pleasure of serving on the Ceres board and stick my nose in a lot of other avenues, which we can get into as we get into the discussion.
Hi everyone, I'm Michelle Levinson. I'm a student. I'm doing a concurrent degree at the Goldman School of Public Policy and the Energy Resources Group. And I am excited to share about my experience working with the UC Berkeley Foundation and the Berkeley Endowment Management Company to design some proxy voting policies.
Fantastic. So let me just give a little bit of a sense of what I've seen over the last, I've been with Ceres now 10 years, but maybe over the last 5, how I've seen a significant shift in our membership and how they talk about these things and what it is they're doing. I would say that when I started, we were really looking at the socially responsible investors, the managers and the religious investors who were really focused on impact, really had a mission orientation, and they were the ones who were leading. The mainstream asset managers, the mainstream pension funds, insurance companies, big banks, were lagging way behind. When I surveyed them, they said, we're not really thinking about this. Our clients aren't really interested in it. Doesn't really fit in our asset allocation studies. We're not really thinking about it when it comes to choosing managers on the owner side. But today it's a very different story. I think what you've heard from the last couple panels is really true for our membership. ESG integration is mainstream at this point. And the question is, how are the investors moving along that trajectory, the timeline that we had at the outset? People are stepping in at lots of different points, but everybody is moving along this line. Many of our investors start with an engagement agenda, so they're thinking about their proxy voting policies, but some, more and more, are starting with an investment belief and really trying to get their boards on board with thinking about ESG integration, naming their value statement from an investor perspective, and then building that into how they do the day-to-day business of investing. So that ESG integration framework established from the top, monitored at the board level, and then implemented throughout. But the engagement side is still strong, and we're seeing people who started off asking for sustainability reports now really diving into materiality and focusing in on what matters most to the investment portfolio. So more and more of the resolutions getting at what the investors believe are really material to the performance of that company. And so they're sector specific, they're asset class specific strategies. We are seeing more and more direct engagement, particularly around carbon, investors coming together and making demands in private engagements, but collectively asking for the same things of the heaviest emitters, companies that will have stranded assets. So that engagement trend, I think, getting more and more focused, and particularly with a risk agenda. And then finally, I think something we haven't talked about yet in this meeting is a push towards policy solutions. And while there isn't much room for a lot of advancement here in the US on policy in the next year or two, we do think that policy framework is going to change the way that investments function. So essentially recognizing that if we don't change the rules of the game, if we don't know what the price on carbon is, our investments are inherently more risky. So investors are coming together to engage in policy at the international level, and now more and more at the state level, recognizing that the price on carbon may move faster at the subnational at the same time as we're working on international level. So that's a trend that I'm seeing. And then we can talk more, and I think Alicia and Michelle will have ideas about this, but looking for low carbon and clean energy opportunities, and how it is members are really focused on finding solution-oriented funds, particularly commingled funds, but sometimes also direct investments in clean energy as a way to mitigate risk across the portfolio. So looking for alpha in those places, but also really understanding that as part of a risk management strategy. We have a sub-network within Ceres Investor Network that calls themselves the Climate Solutions Investment Initiative, CSII, and that staff refer to it as the Coalition of the Willing. This is a group of cutting-edge investors who are saying, we're going to go out and find products that really drive forward a clean energy agenda, and they're coming together to do that. So that's, I would say, a relatively new trend for us. So let me turn to Alicia with the first question. You've been hosting this series of roundtables that you mentioned with investors focusing on integration of ESG in the investment practice. Could you give us an overview of what you've been hearing from your roundtable participants, and what do you think are some of the key barriers to doing more?
Sure, thank you. And I want to clarify the one thing you said in your question, and I've also been stirring this pot a little bit at the table, which is this distinction between ESG and climate risk.
Yes.
And I'll just express my bias here, both in terms of the need for specificity around language, and also in terms of where I'm coming from with our work at Stanford, which is very much a focus on climate and the financial implications of climate from a risk and opportunity perspective. In my view, and we have this very orbital map that put together a couple years ago around sort of the distinction between ESG and climate risk and exposure, but they're not the same. And climate risk certainly has tremendous implications for social issues, for environmental issues, and governance plays a key role in managing climate risk. But I just want to be clear in terms of where I'm coming from and the comments I'll be making. It's around the financial implications of climate. A couple data points I always just like to throw out to level set when we're talking about climate, just to get a sense of, again, and I've approached this conversation from entering the mainstream. You all are here under the banner of Intentional Endowment Network, which I think is fantastic. But there's a lot of dollars, a lot of asset managers and owners out there that don't want to hear those words. They just want the financial, the finance first conversation. And I've actually had the experience of having some people, European delegation, come up to me and say I was too heartless. I didn't talk about the moral side. But I wore Birkenstocks in college. I can't believe you're criticizing me for that. But so here are the hard-nosed numbers. So there are $143 trillion in manageable assets globally. And a recent study, which sort of hits kind of the average of estimates, puts the value at risk of a business as usual scenario at $43 trillion. We're talking about a third of global wealth at risk. In a business as usual scenario. That should wake up any investment manager. And just to put that also in context, the subprime mortgage crisis wiped out about $19.2 trillion in US household income. It's apples and oranges, but sort of gives you a scale. Another data point on climate that I like to use is the economic losses of extreme weather events. So before 1990, the 35 years prior to that, there were on average $5 billion plus weather-related losses globally. In 2016, there were 15 weather-related losses exceeding $1 billion in the US alone. So the world is changing. It's not, the actuarial tables your insurance companies are using to price risk are not up to date, and the sort of data that you're getting around where the risk is in your portfolio is not giving you the full picture. So under that sort of pretense, I've been convening for the last couple of years a very small and not as professionally or well organized roundtable at Stanford called Investing in a New Climate that's bringing asset owners together by cohort. Because as you well know, different asset owners have different stylized approaches to these questions. So we've brought together family offices, we've brought together pension funds, we brought together university endowments. We did a program in Paris for all investors who were there around the Paris climate negotiations. And we're actually convening foundation endowments in the coming, in November. And I'll just share a couple of, we actually surveyed going in the university endowment investors back in December of 2015, and a couple of things really stood out to get to answering your question here in terms of what their, the sort of state of play for these university endowments investors. So first of all, a majority of them coming in said that their leadership believed, and this is the president and the board of trustees, believed that climate was a material and existential risk and that universities had a role to play. When it got to what the role of the endowment was in terms of the university's toolkit, less than half felt that the endowment was an appropriate tool to be considering when addressing climate. And that's at the board level. And the individual investor level, it was even lower. The percentages were lower in terms of it being something that they had a fiduciary responsibility to address. There's also sort of a question of permissions and incentives. So about half felt like their board and gave them permission to make short-term deviations in pursuit of long-term strategies, and that they had long-term compensation structures. What I wish I had asked was what people meant by short-term and long-term in those cases. Based on my experience with endowments, university endowments, you're talking about maybe a 3-year vested time, incentive structure. Still arguably short-term, but longer-term than maybe some hedge fund comp structures. This particular data point was really interesting to me. 75% of survey respondents felt that climate risk was not priced into the market today. So an acknowledgement that efficient market theory falls down in the face of climate change, and yet they're all compensated against passive benchmarks that are missing these systemic risks. So how can you address this mispriced risk if you're comped against a benchmark that isn't pricing it? So this comment came up earlier about sort of what's your tracking error? What are you willing to how much breathing room are you going to give yourself? And this is a conversation with CIOs and boards to figure out, what is our permissible degree of difference that a climate resilient portfolio is going to have in terms of tracking error. So that's an area I think of opportunity from a governance perspective to define that space. If people weren't investing, why they weren't investing, they didn't feel like they had, there was a lack of good managers with track records, lack of internal expertise to evaluate opportunities. For those who were investing, why? Primarily focused on private vehicles across a diverse set of strategies. Renewable energy, energy efficiency, and green buildings were the most popular. And then this one is interesting to me too. I hope it's all a little bit interesting to you. Like who's responsible for this within your your investment professional team or investment committee? And I thought it was really interesting talking to Verity about BlackRock that their team. It's a vector across the whole company. It's not like there's one person who's the ESG person who you go to get your rubber stamp to go do what it is you were going to do otherwise. And so this sort of expertise and muscle being pervasive across endowments is something that I think is really critical, but really varied in terms of responses of whether it was everyone or no one. It was sort of a stacked set of responses. In conversations, last comment I'll make on this, what I thought was particularly compelling in terms of a need to break the mold was I heard from everyone in the room, or they wouldn't have been there, an interest in sort of a recognition that climate resilience and resource efficiency was an investment theme that they were interested in pursuing. But at the same time, with that interest and recognition and pursuit, there was this dissonance with the requirement that managers come to them with a 10 to 20 year track record, with a product that fits off the shelf, with a completely, and yet satisfying this need for a new and innovative strategy with a new and innovative product that obviously can't look like the old ones. And it just silence, sort of meeting that recognition. Mm-hmm. And I was in conversation with our esteemed Cambridge consultants who, there's an intermediary opportunity here too, where that crossroads can be better sort of aligned by expert intermediation, both in terms of the consultancies, but also in terms of some syndicates that are helping investors kind of vet and structure deals, really on the transactional side, less on the consulting side, that also try and reconcile this disconnect. So that's another point.
Really, an important barrier to recognize. Can I ask one sort of provocative question?
Of course.
Where is Stanford on the maturity model?
First of all, it is an entirely new team. The Stanford Management Company of the last 18 months is not the Stanford Management Company of the last 10 years. I would say, here's what the university does really well. The physical plant and property is impressive. The Stanford Energy System Innovations is a $440 million renovation of the campus energy heating and cooling system. They've bought a lot of renewables to supplement that. The university itself is on target to meet its a 2-degree pathway. There's great education and research. I think Stanford's really using its toolkit. When it comes to the endowment, the university has a long history of investment responsibility, starting in the 70s, having formed this APIRL, and I had to get, and Doria's here somewhere in here, she can speak to this too, but the Advisory Panel on Investment Responsibility and Licensing is the name, and it's a mechanism through which anyone in the community can come to the university with an expression of an asset that is causing gross social injury, I think is the hurdle rate. And so Stanford had a process through which the divestment movement could advance that allowed the university to avoid some of the very public and unfortunate battles that I think some of the other universities, our peer universities, ran into. That's the good news. It also, I think, created a vehicle through which the president at the time could make a statement that he really wanted to make, which was to sort of give the divestment movement a win and divest from coal. In reality, that was a terrific headline without a lot of sort of substance to it from the management company's perspective. It was not the management company at all, actually. It was the president of the board of trustees made a decision, got a good headline. In terms of the management company's muscle around climate risk and resilience, they're struggling like the rest of it. I mean, I wouldn't say they're any farther ahead. And in fact, I think having moved to a more traditional endowment model of how they're picking managers, I think they're right back into the sort of earlier end of that spectrum. So that's the honest answer.
Thank you for being so candid about that. Michelle, you've been active as a student leader, and you've had amazing success working with the UC Berkeley Foundation. I'd love to hear a little bit about that process, and maybe with a particular focus on the reforms to the proxy voting policies.
Yes. So first, I want to acknowledge both the Berkeley Endowment Management Company has representatives here, the Chief Investment Officer, and then also a trustee of the UC Berkeley Foundation, and also the University of California Office of the President Endowment. So there's a lot of representation. I'm a student up here. There's students in the audience, and I think that says a lot to the commitment of the university, and I really appreciate personally the opportunity to get involved. So the University of California Berkeley Foundation manages about $1.5 billion of endowment, and the Environmental Social Governance Subcommittee of the foundation has systematically gone through different pieces of policy areas that they've engaged students to design proxy voting guidelines around. So we kind of touched on political spending, and that is an area that the students have already covered with what I'm really impressed by as a proxy voting policy guideline. And so when me and my classmate Colin Mickle went about the process, we started with a lot of interviews. We met with trustees, we met with folks at the Endowment Management Company, advocates around proxy voting, activism, nonprofit sector, asset managers. We had a lot of great information to pull from. We also did a review of 28 different proxy voting guidelines and policies that were from mostly other universities, smaller ones with larger endowments. We reviewed the Principles of Responsible Investing guidelines. There's a lot of resources out there that if you look around, and we found that there is a broad range in terms of the level of detail, and we've heard that today. So when we thought about how we would design these, we had the opportunity to focus. We are focusing specifically energy, the environment, sustainability, and climate. So that bounded us a little bit, and I think you're right to make the distinction. ESG is not the same as climate risk. But the risk part was really salient to us because that's what that's so important to investors. So we ended up, I'll just give you a taste. The topics that we cover, greenhouse gas disclosure, and then also emission reduction plans is something that we included as what managers should be looking for from companies, explicitly disclosed. Physical impacts of climate change, stranded asset risk, of course, and then similar to emission reduction plans, but broader is the business plans for adaptation. And so that goes to, again, what Alicia was saying about the breadth of the economy that is affected, especially by climate risk, and how we should be taking that into account in terms of disclosure. So I think in terms of the process, I would also like to highlight, we didn't only design this, we also looked into implementation, and I think as probably everyone who is managing an endowment right now knows, the implementation piece is the hard part. But for us, that was really exciting because we were able to learn, there are a variety of options. You can give your asset managers your guidelines and say thank you. We hope you look at them, but you may or may not have an evaluation or metrics associated with the policies you handed to them. You may, okay, you know what, we don't know how you're going to do it and we don't trust you, we'll take it in-house, but I don't think anyone would actually do that because it's so much work. But it's an option, and everyone should remember that. And then there are some university endowments, including the University of California endowment, that use proxy voting services, and those can be a very reasonable way to approach your proxy voting engagement. And I think one thing that we saw, and I'm sure there are universities that are making their votes transparent. We already heard from BlackRock that they're working towards that. But the State of Wisconsin Investment Board, you can go on that website and I can see exactly how they voted on everything. And coming back, I'm giving the student perspective. Students want to know that this is not just a rubber stamp and that the proxy votes mean something, and the transparency tools are very simple. They can embed it in your website. They're beautiful. And it gives credence to everything that you all are working so hard to do. And students are future donors. So you have to remember that it really does help.
Wonderful.
So
that's really powerful, Michelle. And I would just add that there's one more strategy. I think you're right to lay out, hand it over to the service, take it in-house, give it to your manager and let them do it. Another one that we're hearing about is endowments who are coming together in coalitions and saying we're not going to try and reform all of our votes. We own thousands and thousands of companies, but we've got a subset of votes that we think will shift whole sectors. And we're going to vote together on those, and coming together in places like the Interfaith Council on Corporate Responsibility or Ceres or the Intentional Endowment Network, tracking particular resolutions and voting as a block. And that's really making a difference. So